Hi, in this lecture, I cover picking stocks and how to analyze companies. So, the question we need to ask is why pick stocks and how to do it. The main reason is higher returns. So, stocks offer potentially higher returns than bonds and even other securities. Better control. You get to manage your own investment portfolio instead of giving it out to mutual funds who use professional managers to do it and charge a fee. So now why do we and now that we've covered why do we pick stocks, let's understand how to do it. So Benjamin Graham, the person behind the book known as Intelligent Investor, had a saying that buy stocks like you would buy groceries. What this means is whenever we go for buying groceries, we try to look for good deals. We try to see whether things are offered at a discount, or whenever things are priced at a point where we feel this is as per our expectations, we buy them. So similarly, the objective of picking stocks is to find stocks that are undervalued, and or this is also known as value picking. Now, the way this is done requires some bit of sophistication, and let's cover the main points here, and then the rest will be covered in more detail in subsequent lectures. So, the first thing is you need to perform an EIC analysis, that's an economy, industry, and company analysis. So, this is a top down approach where you first look at the overall economy, then you look at the industries that are performing well, that is, the outperformers within that economy, and within each industry, you look at companies that are performing well, and then try and find picks find companies which are currently undervalued. So to do the valuation, you need to first do some quantitative analysis of the company's fundamentals. So that involves looking at the balance sheet, looking at the income statement, reading the annual reports, reading various other press releases to understand how the company's standing is financially. Then we need to perform qualitative analysis. So this is more of an art than a science. So far, quantitative analysis is just pure numbers, mathematics. Qualitative is where it gets subjective and things become a little difficult, as there are no standards in which specify as to how this needs to be done. So the general idea is to read up about the company and find where the company has opportunities for growth, and find where the company has warning signs or there are red flags in terms of its future growth. Now let's think of a company in the recent past which has not been doing too well. Come to think of it, BlackBerry is one such company. There used to be a time where business phones meant BlackBerry, but since the domination of iPhone began, BlackBerry began its steady decline. So, if anybody had done a quantitative analysis at the point in time where BlackBerry was dominating without a qualitative analysis, they would have probably thought that this company has very strong fundamentals, and maybe we should invest in them provided that they are priced right. So, the right price may not need not be the sole reason. You have to also see whether it's the right quality. So, just imagine you're buying potatoes and the price is really low. However, the potatoes turned out to be rotten, or they're green potatoes. They don't cook well. So that's where you need to do some bit of analysis. So that's qualitative analysis. You read up about the people who are running the show. That is, you try to understand the backgrounds of the CEO and the board, the composition of the board, to understand whether they have a track record where they they've displayed integrity, and they have the commitment towards growth. Because oftentimes change in the composition of board can also mean either it can mean something which is good, that is, the company might now do better because the newer people have come and these people have a good standing, or it can mean the other way around. So that is, a company which was doing really well has now got a new managing director, and now this person has a colorful past, in which might even be something which he can repeat. There might be some mistakes which he has done in his past, which he is obviously likely to do it again. So that can only be caught through careful tracking of a company. So this is where monitoring gets really it becomes an art. Next is you derive the intrinsic value and you compare it with the market price. So from the quantitative analysis, you can get a preliminary intrinsic value. Now the objective of the qualitative analysis is to arrive at a margin of safety. So now once you have the initial intrinsic value, you want to either put a discounting factor or not, depending upon the discoveries that you've made during the qualitative analysis. So let's say, for example, the management has now appointed an inexperienced person who has no reputation in the market. You would probably want to put a certain discount rate depending upon your risk appetite. So if you feel that no, this person isn't somebody which with a proven track record, and I would say I would reduce the intrinsic value by 10%, whereas somebody else might say, you know what, maybe I would just reduce it by 5%. You're both not wrong and you're both not completely right either, because nobody knows what the intrinsic value will what the market price will be tomorrow. But what you're right in is you're actually taking a certain qualitative aspect and giving it a quantitative notion, so that you can be prepared for any particular setback in the market price. That gives you a sort of a life vest in the case of turbulent times. So deriving the intrinsic value also involves is a bit of an art and a science. So we have quantitative analysis, which is completely mathematical. We have qualitative analysis, which is artistic, and we have intrinsic value, which is a blend of the two. And once you arrive at the intrinsic value, you need to compare with the market price. Now if the market price is above, obviously it is overvalued, you wouldn't want to buy it. And the other way around, it's perfect for you to buy, because now you feel it's a value stock. Okay, so that covers this lecture. And if you're watching this on YouTube, please click subscribe. You'll get updates on videos and various other material which you'll find very useful. Thanks for watching. I'll see you in the next lecture. Bye for now.